Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that is absolutely crucial for anyone looking to navigate the financial markets: understanding market trends. Now, you've probably heard the saying, "The trend is your friend." It's a classic for a reason. But what does it actually mean to identify and analyze these trends? How can we use them to make more informed, confident trading decisions? Well, that's exactly what we're going to break down over the next few minutes. So, grab a coffee, get comfortable, and let's get started. First things first, what exactly is a market trend? In the simplest terms, it's the general direction the market is moving over a period of time. Think of it like a river. A river doesn't flow in a perfectly straight line. It ebbs and flows, it has ripples and waves, but it has an overall direction. The market is the same. It doesn't move up or down in a straight line. Instead, it moves in a series of zigzags, creating peaks and troughs. The direction of those peaks and troughs is what constitutes the trend. There are three main types of trends you'll encounter. The first is the uptrend. This is what everyone loves to see in their portfolio, right? An uptrend is characterized by a series of higher highs and higher lows. Imagine climbing a staircase. Each step up is a new high, and the flat part of the step you just left is a higher low than the one before it. When you see this pattern on a chart, it indicates that buying pressure is stronger than selling pressure. Investors are optimistic, and they're willing to pay progressively higher prices for an asset. On the flip side, we have the downtrend. As you can guess, this is the opposite. The downtrend is marked by a series of lower highs and lower lows. Think of walking down a staircase. Each step down is a new low, and the step you just left is a lower high than the previous one. This pattern signals that selling pressure is dominant. Sentiment is generally pessimistic, and sellers are driving the price down. And finally, we have the sideways trend, also known as a range-bound or consolidating market. In this scenario, the price is essentially bouncing between two horizontal levels, a level of support on the bottom and a level of resistance on the top. There's no clear direction up or down. It's like the market is taking a breath, with buyers and sellers in a state of equilibrium. This period of consolidation often happens before the market decides on its next big move, either breaking out into a new uptrend or breaking down into a new downtrend. So, now that we know what trends are, how do we actually spot them? The most fundamental tool in a trader's arsenal is the simple trend line. To draw an uptrend line, you just need to connect at least two of the major lows. For a valid trend line, you'd ideally want to see the price touch it at least 3 times. This line then acts as a level of dynamic support. As long as the price stays above this line, the uptrend is considered intact. Conversely, to draw a downtrend line, you connect at least 2 of the major highs. This line then acts as dynamic resistance. As long as the price remains below this line, the downtrend is considered to be in effect. A break of these trend lines can be a powerful signal that the trend might be reversing. But remember, one break isn't always a confirmation. False breakouts do happen, which is why it's important to use other tools in conjunction. One of the most popular tools to help confirm a trend and its strength are moving averages. A moving average smooths out price data to create a single flowing line, making it easier to see the underlying trend. The most common ones are the 50-day, 100-day, and 200-day moving averages. When the price is trading above a key moving average, like the 200-day, it's generally considered to be in a long-term uptrend. When it's below, it's in a downtrend. You can also use multiple moving averages together. A classic signal is the golden cross, which occurs when a shorter-term moving average, like the 50-day, crosses above a longer-term one, like the 200-day. This is often seen as a very bullish signal, confirming a new uptrend. The opposite is the death cross, where the 50-day crosses below the 200-day, which is a bearish signal. These are not foolproof, but they are powerful indicators that many institutional traders watch very closely. Another layer we can add to our analysis is market structure. This goes back to our definition of trends. Are we seeing higher highs and higher lows? Or are we seeing lower highs and lower lows? Actively identifying these swing points on a chart is a core skill. A change in this structure is often the first clue that a trend is losing steam or about to reverse. For example, in a strong uptrend, if the market fails to make a new higher high and then breaks below the previous higher low, that's a major red flag. It's a sign that the bulls are losing control and the bears might be stepping in. This change in market structure often precedes a trend line break or a moving average crossover. Let's also talk about the different time frames for trends. Trends exist on all time frames, from the 1-minute chart that a day trader might use, all the way up to the monthly chart for a long-term investor. We generally categorize them into 3 durations. The primary or long-term trend can last for more than a year. The secondary or immediate trend is a correction within that primary trend, and it can last from a few weeks to a few months. And finally, the minor or short-term trend lasts anywhere from a few days to a few weeks. It's crucial to understand which time frame you're trading in. A day trader might be looking to profit from a minor downtrend, even while the primary trend is clearly up. A long-term investor, on the other hand, might see that same minor downtrend, a buying opportunity, a chance to add to their position at a discount before the primary uptrend resumes. So, always align your strategy with the appropriate trend time frame. A great technique is to use multiple time frame analysis. Start with a higher time frame, like the weekly or daily chart, to identify the primary trend. Then zoom into a lower time frame, like the 4-hour or 1-hour chart, to find entry and exit points that are aligned with that larger trend. This helps you avoid trading against the current of that big river. So, to put it all together, how do we use this knowledge in a practical trading strategy? A popular approach is trend following. The idea is simple. Identify a clear trend, enter a position in the direction of that trend, and ride it for as long as it lasts. For an uptrend, you might wait for a pullback to the trend line or a key moving average, and then enter a long position when you see signs of a bounce, like a bullish candlestick pattern. Your stop loss could be placed just below that support level. For a downtrend, you do the opposite. You'd wait for a rally up to the downtrend line or resistance moving average and then enter a short position. Your stop loss would go just above that resistance level. The beauty of this strategy is that you're trading with the path of least resistance. You're not trying to be a hero and pick the exact top or bottom. You're just flowing with the market's momentum. Understanding trends is not about predicting the future with 100% certainty. No one can do that. It's about using historical price patterns to gauge probabilities. It's about putting the odds in your favor. By analyzing trends, using tools like trend lines and moving averages, and paying attention to market structure, you can build a robust framework for making trading decisions. You're moving from a place of guessing to a place of educated analysis. This approach helps you manage risk more effectively and increases your chances of achieving consistent results over the long term. Remember, becoming proficient at trend analysis takes practice. Spend time looking at charts, draw trend lines, add moving averages. Identify the different types of trends across various time frames and assets. The more you do it, the more intuitive it will become. You'll start to see these patterns emerge naturally. That's all for today's deep dive into market trends. I hope this breakdown has given you a clearer understanding and some practical tools you can start using right away. It's a fundamental concept, but mastering it can truly transform your trading journey. If you found this video helpful, please give it a thumbs up. It really helps the channel grow. And don't forget to hit that subscribe button and ring the bell so you won't miss our future content. Let me know in the comments if you have any questions or what topics you'd like me to cover next. Thanks for watching, and I'll see you in the next video.